All right, so I was at a meeting today and I got a call from someone who asked me what's going on with the stock market. Should we put our money out of our mutual funds? Is it going to fall further? And there were a bunch of messages like that from various people over the last 2 days. And the interesting thing about this is most of these guys were mutual fund investors. And normally, when the market starts to fall, it is the stock investors who get nervous first. The mutual fund guys are the ones who get nervous last. So if you're doing an SIP, you are normally by nature the last person to get nervous about a stock market fall or a correction. Which means that if the mutual fund investors are starting to ask this question, it means that we're at that point where we need to discuss what is going on. So in this video, we're going to talk about what's happening with the Indian stock market, why it's falling, is it likely based on that research to fall further, and finally, what should you be doing now depending on your horizon. And we're going to try and get more experts to talk to us about this in the days to come. But today, let me just share my screen because this is a really data heavy story. And I want to be able to show you some things. Now, the Reuters website actually has some great data, but this headline is a little like, whew, wiping out $1 trillion in wealth. The Indian stocks have their worst run in 25 years. Now, this is what the Reuters data is saying. But I want to show you this screen, that's up right now. This is the Nifty and the Sensex. Now, they have very helpfully put this chart upside down. But you will see at the bottom here, those green bars, these are the guys who are performing really well, global markets. And in comparison, the Nifty and the Sensex here, these first two bars, the big red bars, are the worst performers out of the big global markets. And this is percentage of change since September 30th, so 1st October onwards. You'll see the DAX is actually the German index, and then Hang Seng is Hong Kong. Dow Jones and Nasdaq over here up 2%, and this is reaction after Trump took over. Here at the very bottom, on the very top, 13 to 14% is where the Nifty and the Sensex are. So this is not a place that we are used to being at in India, because we are normally used to being a global, we tend to outperform global markets, but here we are underperforming. So among these global markets right now, we are at the bottom. Now, this is the other piece of data I wanted to show you, and this is the thing that's making everybody uncomfortable. Now, I know it looks a little bit like what is going on here, but this is the entire lifetime of, nearly the entire lifetime of the Nifty. And you'll see these two gray points, right? So there's a gray point here, and there's another gray point here. This is the Nifty month on month. So every line you see is 1 month. So in 1996, which is this gray bar that you see here, was the last time that the Nifty registered 5 straight months of fall. So these red lines that you see here. And after that, if you see, it's never fallen for that long in a row. It's always come back up, gone down, come back up, gone down, come back up, until here, this bar where we are today in 2025, where we've seen 5 straight months of a losing streak. And that is what is making people really uncomfortable about this drop. Foreign investors have apparently sold $25 billion from the Indian market. And if we see here, this is the FII and inflow and the outflow. So there are, when you say FII and DII, there's foreign institutional investors, so basically big funds, pension funds from overseas that buy into the Indian market. And then DIIs, which are domestic institutional investors, so mutual funds, LIC, insurance companies, other big funds in India that tend to buy into our market. So you'll see the green bar here, this is a this is a month-on-month chart, I beg your pardon. And the green bar is the domestic funds, and the red bars are the foreign funds. So you see one drop here, and then we'll see 2 straight drops for January and February when the foreign investors have pulled their money out. And that is what is making people really uncomfortable now, saying, okay, what is going on here? So if, from the chart that I showed you, since its inception, the Nifty has registered back-to-back monthly loss for 5 months only back in 1996, as we showed you. So what's happening right now is that we are underperforming the global markets, which is sad. We're seeing our longest streak, losing streaks in September, and also small caps and mid cap stocks are taking a massive beating. Now, this normally happens when the market falls. Small caps and mid caps take a larger beating. The large caps are more stable, and when the market rises, the opposite tends to happen. So I will just show you what small caps and mid caps are looking like right now. They've lost about 13-ish% this month in February alone, and altogether they have lost, since their record high levels last year, about 26 odd percent. I'm just going to so this is that losing streak I was showing you about. So this is the India mid cap, the Nifty mid cap index, right? So this is the mid cap 100 mid cap stocks on Nifty. Now there are two things I want to show you here. This is the line from where we started. This is from September 1st, October onwards, when we actually started seeing this correction. Down 10%, which is this midline, is the sign of whether this is a correction or not. Now, according to this chart on Reuters, we have now hit, for the mid-cap stocks, we're down 20%. So according to Reuters, this chart is confirming a bear market, which means that this is not just a correction of valuation, because there was a feeling that around that time, especially last year, 2024, we had run up too high, and our actual numbers of corporate returns were not supporting the run up that we had shown. And so this is not just a correction. According to this chart, the mid cap chart shows that we are in a bear market at this point. Now, looking at industry-wise sectors in India, in our Indian market right now, this is a percentage monthly change. So this is just in the last 1 month. In February, you'll see private banks are holding a little bit better, although the news on private banks, on expectations for the future, is a little weak right now. So private banks, finance, metals, just general banks, so all banks together, Sensex, Nifty, these two bars is the index. So are you performing better than the index or worse than the index? That is all the way down here. So this is real estate, this is public sector stocks, small cap, I just talked to you about it, IT, energy, mid cap, FMCG, PSU banks, auto, oil and gas, and pharma. Now, what is in common with these? See, IT, oil and gas, pharma, a lot of this will have to do with what America is doing, because these are sectors that interact a lot with the globe. So we're seeing really that cut across. Now, this is what India's Nifty 50 stocks in February look like, and this point here, this bar here, you should need to keep an eye on. It's a little difficult. So just watch where my cursor is. That is 0. So these, and when we say Nifty 50, these are the large caps. These are the biggest stocks in the market. So this is everything from your, say, Axis Bank, HDFC Bank, Tata Steel, SBI, Infosys at the top, see, Wipro, L&T. These are the biggest stocks in your market. These are the most stable stocks in your market. So from this line onwards, you will see HDFC, Axis Bank, Bajaj Finance, Shriram Finance, mostly finance banking stocks, are still slightly better off for February, but everybody else has lost in February. And the worst performers, tech, auto, Tata Motors, M&M, Mahindra & Mahindra, ITC, L&T, Apollo Hospital. So that whole line is here. So that is what the entire, the large caps are looking like right now. And that's what we're looking at. So now let's take a look at why this is happening, right? What is going on in our market that we're taking such a massive beating? There are about 4 or 5 reasons that I'll take you through them. The first one is that, and remember, we did a video on this a little earlier. You can look at that video as to why the Indian economy was seeming a little iffy, and there was one video I put out on why the Indian rupee was failing, right? So we at that point talked about how consumption was not doing very well in India, and that is now showing on the stocks and the earnings. So basically, all of these big companies that function in India will do well if the Indian consumer buys more. What we've seen now is a sharp slowdown in profit of Indian companies. So the earnings growth of the Nifty 50, so these companies that you see on your screen right now, their profit growth is only 5%, on an average for the October-December quarter. And that's the third straight quarter where we've seen only single-digit increases, after 2 years of double-digit increases. For the last 3 quarters, we've seen only, single-digit. We've now crossed a 10% growth in earnings. And this is because urban demand has weakened and people in urban India are not buying anything because prices are too high, their salaries have not grown, and inflation is high. And I'm not going by the actual inflation number, but think about the fact that your healthcare inflation goes up 14%, education inflation, so school fees are going up 14-15% a year, your salaries are not growing, so people don't have the extra money left in their accounts at the end of the month to spend on anything discretionary, and that's what we're seeing now show up in the returns or the profits that our corporates are showing. So, an we just had a GDP growth number that has come out for the same quarter, and it is at 6.2. Now, it's not worse than what was expected. 6.4 is what we were expected. We got 6.2, but it's not a great number. Like, it's not something that will cheer the market. It's like, okay, we expected, we got meh. So, there's no good news there. So, for example, the Chief Investment Officer of Kotak Mutual Fund has given a statement to one of the newspapers where he said corporate earnings is missing expectations and there's uncertainty over US tariffs, and I'm going to get to that, and that is why we are seeing this right now. Now, the worst piece of news that's coming in, and this is from an article in the Mint, Avinash, who is the head of Profitmart Securities, has basically said that there is buzz that Q4, which is the last quarter, January to March, Indian banks are expected to show weak earnings, and that is going to be really disappointing because the market, he says, will not be able to digest that news. And that is because, and if I show you this again, you will notice here private banks are holding up a little well. So if private banks actually post weak numbers for the quarter, then that is bad news. So market, remember, doesn't react to what is happening right now, it reacts to what it thinks it's going to happen. So it thinks that the Indian banks are going to post weak numbers, and those are results that you're already seeing show up in our stock market, and that is why there is a disappointment. Now, the second thing that we must consider is, and we'll take a look at, it was underperforming the global markets, which I already showed you. This is sentiment among fund managers, which basically means, like I told you, what do they expect will happen? So the market is not reacting right now to what is happening, but what they expect will happen. So this is Asia Pac sentiment among fund managers. Do they think it's going to do well? Do they think it's going to do badly? They think the Japan, Taiwan, China is going to do well. Singapore is going to do well. And what do they think is going to do badly? You'll see right at the bottom there, there's Thailand, and above Thailand is India. Right there where you see my cursor, and that is why. And this is there are about 205 panelists who have been polled for this, and this is what they're showing us, that they are very bearish, that Asia, they're very bearish on our stock market. Now, this is an interesting chart I want to show you, and this is perhaps where we are getting an idea of, do we expect the market to fall further? Again, these are expectations. Now, this is a chart that Reuters has put forward. Sector-wise earnings per share growth outlook for Nifty companies. So, basically, what is the outlook? What do they expect will happen? So, for FY 2025, which is the year that we will close at the end of March, if you'll see here, the expectation is not great. The outlook is not great for most of the Nifty. It's just 2 sectors or 3 sectors that are expected to do well. But it's not all bad. If you look at 2026, FY26, which means the year that will start April onwards, you will see that it's actually, the expectations improve drastically. So they are expecting this year to be bad, but they're expecting next year, the next financial year, to do much better. And there are reasons for that. The government has taken certain steps. There's going to be spending more money. It's actually given that tax break, which means a little more money in the hands of the people. So there are some positive expectations 2026, FY 2026 onwards, but right now the expectations are not great. Now, the next reason why this is falling is because of the rupee. I just want to check if my laptop might go off. 1 second. The rupee is actually falling even further, and this is thanks to Mr. Donald Trump. It's fallen even further on Friday than a it's crossed whatever, support the RBI could have offered it, and it's fallen further. This is largely because Donald Trump has actually threatened tariffs on Canada and Mexico, which will come into effect on the 4th of March, which is next week. And everyone had expected that by that time something would change, but it has not. It doesn't appear like something has changed. And he's just reiterated just yesterday that he's going to do this again. He's going to do those tariffs on Canada and on China. China has responded saying, hey, reciprocal, I will also put tariffs on you. So it's all of these signals of a global trade war that might actually start off, and they'll start slapping tariffs on each other. And what we took for granted as this is the lay of the land is going to change, and that will mean bad news for markets. I mean, global markets are reacting to it right now. And as a result, our rupee has dipped further, and that has had an impact on our stock market as well. So take a look at this story, for example. Yes, I'm still on the Reuters website. I really like their website. The dollar drawing strength from Trump's tariffs. And if you just look at this 4-point summary, looming tariffs are dominating market moves across the world. Bitcoin is falling. I mean, honestly, the Bitcoin deserves a separate video by itself. The dollar is supported but on track for a monthly loss. And so because the dollar is moving, our rupee, along with the rest of the world, is reacting to that. The other reason, and here this is the reason I want to take you through next. We talked about Trump's tariffs. There is a slogan apparently that goes by "Sell India, Buy China." So what has happened recently is that the Chinese stock market is getting a lot of attention, and a lot of global investors. So FIIs, I told you, foreign institutional investors, are pulling their money out of India and moving it to China, or pulling their money out of India and moving it to US equivalent of fixed deposits, basically, because the interest rates might go up in the US, the dollar is moving, so that is something that they are finding it interesting. So let me just give you some numbers. Foreign investors had actually in 2024 bought $12 billion worth of Indian stocks. In 2025, they have sold $25 billion worth of Indian stocks. In between then and now, and of which $12 billion has been sold only in January and February. So fund manager allocations to India apparently at Bank of America has released a survey that says Indian allocations to India are down to a 2-year low. And like I told you when I showed you that chart, Thailand is the only one that's faring worse than us. And because the Chinese market is doing well, the Chinese market has seen some corrections apparently. The valuations are more attractive than India. The other thing is, of course, DeepSeek that suddenly came up and surprised us, and everybody's like, oh, okay, China has a really viable AI game. And their AI game seems to need less electricity, needs less cooling, smaller data centers, which means the big guys in the US might be threatened by it. Big stocks like Nvidia actually lost a lot of value because of it, and that has actually propped up the Chinese market. And so they believe that there is money coming out of India, so there's a portfolio flows benefit. There's a sell India, buy China rant, and that's one of the reasons. See, DeepSeek push. That's one of the reasons why our market is doing badly, is because people are pulling money out of our market and moving it to China. Then, of course, there's a US bond market that's doing well, and a lot of foreign investors are withdrawing from Indian securities and moving it to the bond market. And this is intensified after Donald Trump took over, and that's led to more capital flows coming out of India and moving away to other locations. Okay, now comes our next big question, which is, are we expecting this to continue? Now, this is a chart I wanted to show you, right? And take a deep breath. I know it looks like what is going on, but there's a very helpful circle over here, and this is the Business Standard that has done this nice chart for us. The Business Standard has some interesting coverage also, might be worth looking at. This is the entire lifetime of the Nifty, which means I want you to only look at this circle here, which is where we are. And you'll see these candles. These are the 5 straight monthly loss that we're talking about. So that same line that I showed you earlier, this is it's a candle graph of the same thing. And then, effectively what I want to show you here is that even if we are in a bear market, in the lifetime of the Nifty, despite the dips that we have seen at various points, we've always gone up. So are we going to fall further? If we look at this chart, and given the mood right now, it's likely the correction is not over. It's likely that we are in a bear phase, of the chart check that we're looking at right now. But if you look at this line, you will see that the estimates for next financial year are not so bad. So there is an expectation that the government is going to step in. It's going to do, the things that are necessary, like, spend the money to create more cash in the market, leave more money in the hands of the people, simplify the system, maybe also create jobs, which is what is really necessary, and the market might react to all of those things. So fundamentally, should you be pulling out your money? Well, if you ask me, and if you ask most of the long-term mutual fund advisors, they will tell you that if you're in for the long term, which means this is not money you need tomorrow, and you can hold off for another 6 months because you don't need to touch that money right now, then it makes sense to just leave it in. It might even make sense to buy a little bit more at a staggered point, because you might not get this point again. Now, some people are asking, can we take the money out and come back in at the right time? You will wind up actually losing, because it's almost impossible for us to time that right time. And so you'll wind up holding money in your bank account, and the market will turn and you will have missed that point. So if you look at it over the lifetime, it's actually not so bad. If you look at only this circle, it seems like sweet hell has broken loose. So I would say, unless you need the money right away for whatever reason, in which case it shouldn't be in stocks or equity at all, and you're nervous about it because you don't want this to fall further, then maybe consider taking it out. But if you can hold off for 6 months to a year, and this is long-term money, so this is retirement money, this is college education money, this is money that you're not going to need for the next, 5-10 years, because you put it away for the long term, then just leave it there. In fact, buy some more. I'm a big believer in SIPs and mutual funds, and I like to top up my mutual funds every time the market cuts a little more, because I believe that I'm able to sort of buy on discount, right? So that's what I believe, really. So that's my advice to you as well. Leave me questions at the bottom of this, at the bottom of this video, on questions that you have about the stock market, and we'll try and bring in experts who can answer those questions for us over the next couple of days. And it's likely, like I said, this is going to be a conversation for a while. So we're going to try and do that for you. But hold your horses, don't panic right now, and don't make any sudden moves. Try and figure out what's best for you based on your long-term outlook. Don't react to the guys who are trading on a daily basis, because that's not what you and I are doing. We're not sitting in front of our laptops all day staring at the chart saying, come in, come out, come in, come out. That's not what we do. We're retail investors, and if you stay invested for the long term, it might actually pay off. All right. So comments in the comment section of what questions you'd like to ask and what we can get answered for you on the stock market, and anything else that we can clarify. And I hope you found this useful. Give me like thumbs up if you think this is useful, and I'll try and bring you more data-led stories. Okay. Thanks for watching.